Right, back live with you tonight on In Focus, and thank you for staying with us. Majority of the Monetary Policy Committee members resolved to increase the interest rates by 25 basis points to 7.25%. This is the 9th increase since the current hike cycle, which began in November 2021, totaling 375 basis points over that period. That's a calculation that has been done by Saftu. As of tomorrow, the prime lending rate will be sitting at 10.75%. For some reaction on this increase and how ordinary South Africans are affected, we're now joined by Nolwandle Mthombeni, a senior banks analyst at Intellidex, Econometrix chief economist, Dr. Azar, Jammine, and Trevor Shaku, who is speaking on behalf of Saftu, the South African Federation of Trade Unions. Good evening to you all, and thank you very much for your time and joining us tonight here on In Focus. Let me start with you, Trevor, because you're here with me in the studio. You call it neoliberal monetarism. They call it what is called the monetary policy normalization. What's the difference?
Look, there's no difference as such. The purpose of normalizing interest rates policy, interest rate hikes in the manner in which they have done in the past few months, in fact, in the past 14 years, is actually following in the footsteps of the prescripts of monetary neoliberal monetarism. What is neoliberal monetarism? It is a thought or a school of thought that many of the central bankers across the world are actually utilizing, which says that the inflation is everywhere and every time a monetary phenomenon. That means that it flows from excessive money supply. And as a result, they always target the demand side to try by all means to reduce aggregate demand so that they can be able to fight inflation. And this is what they've done in the past period. We are rejecting this particular policy path or policy rate path that they've taken as a monetary, neoliberal monetarism, but secondly, not just for the purpose of rhetoric, but because there are tangible results and impacts that come out of that. One of that...
We'll get to that. I want you to go slowly tonight because I don't want you to leave us, and I want everybody to get us. Dr. Jammine, let's bring you here. Given how high inflation is, was this the right call?
It was certainly the right call, and a very sensible and sensitive one by the Reserve Bank. Many economists, the majority apparently, were calling for a 50 basis point rate hike, and the Reserve Bank decided to be more modest on this occasion, to increase it by just 0.25%. And it did so precisely because it felt that the growth in money supply would slow down because the economy would be so weak in the face of intensified load shedding that there would be very little additional upward pressure on prices. Businesses would find it very difficult to keep passing on cost increases, and so there was no need to have to raise interest rates by as much as the majority of economists and neoliberals suggested. And to that extent, I think the Reserve Bank was very realistic about it. And it has now brought our interest rates for the first time to levels above the inflation rate in several years. And that is a major milestone in terms of managing to get above the whole inflation bogey without destroying the economy completely.
We'll come back to that also in just a moment. But Nolwandle, let me bring you in here. It is said that much of what is driving this inflation is fuel costs because of the situation with the war. In our own instance as well, it is electricity load shedding, pretty much being the drive of what we are seeing here, and that in itself extending to food costs going up. Why must we then punish consumers for external factors that really have got nothing to do with them?
I think the word punish consumers is a strong one. The Reserve Bank is out pushing on punishment. I think it's just, the nature of economics is that inflation needs to be contained. And part of the tool that monetary policy has is the ability to increase rates or raise rates. And at the same time, when the rates were low, the rates did go down. And when interest rates go up, then similarly, and when inflation goes up, similarly, interest rates will go up. So the good news is that they did reduce the rate cycling cycle. It was much deeper and deeper. So it's become quite shallow now with the 25 basis point hike. And it's showing the fact that, they're realizing that we need to come to an end now because inflation expectations are now better, and the outlook is that we will be within the target range of 3 to 6% in the current year. So it's not about punishing consumers, it's about containing inflation and sticking to the mandate that the Reserve Bank had, which ultimately is important in maintaining credibility as an institution, one of our most revered institutions in this country.
All right. Trevor, now that has set the scene, because I wanted them to say this because this is precisely what you are arguing against, right? You are arguing actually it is punishing the consumers who already don't have money in their pockets. As Jammine says, in fact, it's a good thing that for the first time that the interest rate is above inflation. You, of course, are saying inflation targeting is way too low. It should actually be much higher than where they are currently targeting it. Make sense of it.
What we're actually arguing is that the method of interest rate targets, of targeting inflation through interest rates, is actually one of the most inhumane and most way of punishing, as you put it earlier, way of punishing consumers. Because in the main, what these people do is that, like they say, excessive money supply, you need to cap it by raising interest rates, meaning you are raising the cost of borrowing, but also those who already have financial liabilities such as home loans, mortgage bonds, car loans, also would have to pay more. In that instance, we are saying that you cannot approach at least every other form of inflation with interest rates. And all of these economists actually agree commonly that the current inflation is as a result of supply bottlenecks. They can explain whether these supply bottlenecks, but what it indicates is that this is not coming from the demand side. So why do you raise the interest rates to limit and reduce the money supply, the money in the pockets of consumers?
Let's stop there. Let's all stop there. Azar Jammine, Dr. Azar Jammine, come in here. Are you in agreement that this inflation is not because of demand, but it's because of supply chain bottlenecks? And therefore, why then, do you want to raise interest rates so that people don't have money in their pockets and therefore reduce demand?
Because if you don't act now to some extent, and I would agree with Trevor that there are limits to the extent to which one should be raising interest rates in the face of supply side issues as opposed to demand side issues. But if you leave it completely on its own and let these prices carry on increasing due to supply side issues and keep your interest rates extremely low, before long you're going to see people starting to borrow money like crazy in order to start being able to spend, and they know that they're paying next to nothing as interest. And you suck them in to a hole from which they will eventually be unable to get out, because their debt levels will rise to such an extent that the initial impetus through supply-side issues will vanish into oblivion, and we will have an inflationary cycle second to none, and a massive debt burden that poor consumers will be unable to keep pace with. There is another aspect to this that I think needs to be borne in mind and hasn't been raised so far. And that is that we are, unfortunately, whether you like it or not, part of what is known now as a global monetary system. And if we start bucking the trend, as some countries have done, in next to no time, you'll end up seeing your currency depreciating massively, imports becoming completely unaffordable, inflation surging ahead, and interest rates rising to levels much higher than they are right now.
Yeah. People will go borrow. If you keep it too low, they'll go borrow a lot and they will trap themselves and it will be a disaster. Or other than that, of course, we are in a global system. And if we don't, that could certainly put us in trouble.
Look, let me start with the first one. People who are indebted and the costs of servicing that debt are not too high would not really suffocate those people who are holding debt at that particular point. At this point, you already have people who are holding debt. In fact, if you check the Experian Consumer Default Index, which was released for Q3 of 2022, it has shown that a lot of people have defaulted on a number of those loans and credit facilities which they are holding, ranging from home loan to car loans. And this, in total, actually goes to hundreds of billions of the money which people could not be able to pay as a result of the default. And these defaults are arising out of the fact that there is interest rates going up. But this thing is not only affecting the consumers as such, it is also affecting consumers indirectly through small business enterprises. Small business enterprises, 1,900, the statistics South Africa released a report that 1,900 of the businesses actually closed in the whole of 2022. Most of them, of course, attributing factors to load shedding and Eskom, but also, again, to the default in the debt they have. Now, when you push through interest rates, these small businesses into bankruptcies, it leads to retrenchments because they end up closing their businesses. This further puts most of the working class people in debt. Actually, it puts them also out of a position where they can be able to afford. The rising cost of living is growing, but they are losing their employment. But also let me point out another impact of these interest rate hikes. In addition to these small businesses going bankrupt and retrenching, we think that it is actually the purpose of the neoliberal monetarists to induce unemployment so that they can be able to keep the money supply, because theirs is money supply. Mantra is that you keep the money supply. So they are inducing some of these bankruptcies, which leads to collapse of small businesses, retrenchments, so that at the end of the day, you are going to keep the money supply as more people become unemployed. Those are the most vicious, inhumane methods of trying to fight inflation.
Back live with you tonight, and the conversation continues. This is around the decision by the Reserve Bank to hike the repo rate by 25 basis points. Some information coming out here in this particular debate around what possibly we could be looking at as a way of curbing inflation. Nolwandle, let me bring you back in here. Are we likely then, therefore, as Trevor puts it, going to see more consumers defaulting because of the consistent hike cycle that we have been seeing, at least for the past 12 months or so?
Indeed, Trevor is correct. In fact, we really started seeing signs of distress within banking client sectors early as already August last year. Kind of dynamics that played out is that there was a huge growth in lending in terms of mortgage lending as well as vehicle financing. Banks, like many other central bankers, also didn't foresee that inflation would move so quickly and so fast. And the rate cycle would turn around so quickly. So as a result, there was a lot of credit going out to the system. It's not an excessive amount, but inappropriate for where rates were at the time. And what we started seeing is now that consumers did come under pressure, especially those that went out for vehicle financing, that took on a lot of pain. And we started seeing this even on the back of the books of the banks, where there's more provisions and more impairments coming through, because it's a very tough environment and consumers' income has been taking a big hit.
Yeah. Dr. Jammine, policy rates, are they an essential tool in monetary policy normalization? Because I did a bit of reading that you do have other not so conventional measures that you can use in monetary policy normalization. The Fed, for example, uses them where they would be reducing their assets in some way. Not quite sure what the terminology is, but it's something to that effect.
Yes, you're absolutely correct. There are a number of, interest rates is one mechanism. Another mechanism is by controlling the amount by which banks are able to lend money out to individuals and companies, through what is known as the reserve requirement. In other words, what proportion of their assets do they have to keep in as reserves by law And if you increase that proportion, you basically force the banks to cut back on their lending, and that in turn tightens monetary policy and works towards beating inflation. The one that you're referring to is now called quantitative tightening. It's a form of monetary policy that began being adopted after the global financial crisis in 2008 that has gained a lot of momentum since the COVID crisis emerged in 2020, whereby the central banks deliberately started buying back the bonds of financial institutions that they had been buying over many years to finance the deficits of governments. And by buying back those bonds, they would give those financial institutions extra money, and they would get the bonds as central banks. And with that extra money, the financial institutions would then be able to go and lend more money out. But unfortunately, what we did notice is many of them went out and simply bought more and more shares, and more companies, led to more concentration of ownership and power in the hands of a few companies, and led to higher and higher inequality. Okay. What the policy that's now being adopted, certainly by the U.S. Federal Reserve Board, is to reverse this through what is known as quantitative tightening, where the central bank is now selling back those bonds that it had bought from financial institutions back to those financial institutions in order to suck up that liquidity to have a similar kind of effect as the raising reserve ratios, and to force the banks to lend out less money. Yeah. Now, in America, that was absolutely necessary because the inflation that they experienced was due to excessive levels of demand as a result. When they opened up after COVID and loosened the restrictions, people went bananas borrowing money and spending it, and that's what's caused their inflation. It's one of the reasons why their inflation rate went a lot higher than South Africa's. In South Africa, we haven't really adopted those kind of tools at all, and that is why we don't need to tighten quite as much either as those other central banks overseas have done.
So, Trevor, you're suggesting they must loosen. In fact, you're saying they must industrialize. So they must borrow people money to start factories. You're saying this will create employment, it will create more product and more services, and people will be employed and have more money in their pockets.
Yes, Thabo. That is actually what we are arguing. There is a report that is released by the Statistics South Africa called Manufacturing, the Underutilization, wara, wara, wara. I forgot the rest of the subtitle. But what that statistical report does is to try to measure the amount of the industrial capacity we have in the country. And then out of that, how much do you use, right? So it reported quite for some time now that the idling industrial capacity, meaning the industrial capacity that is not utilized, is more than 20%. Actually, the last report showed that it was 21.7%, which means that there's a lot of capacity in the industry that can be used to produce goods and services. And because if indeed what they are saying is correct, that demand is the one causing inflation, therefore, if you power the idling industrial capacity, you are going to increase the production of goods and services, and that on its own will have deflationary effect on the price of goods and services. This is the method we say they must use. We say they must use not only because it is deflationary, but also because it's humane. It will lead to the creation of jobs, because to be able to power those particular idling industrial capacity, you are going to have to hire more workers so that they can be able to work there. There will be more income, but also at the same time you will also be dealing with the issues of inequality and of unemployment, which relates mostly to the distribution of income. So these are the methods which, as the South African Federation of Trade Unions, we say they must utilize. And let me show you just also to prove the contributing factors, amongst others, to the underutilized industrial capacity are coming from the insufficient demand. You see this? This is statistical report from Statistics South Africa, a very authoritative body for that matter. It says the reasons are coming from insufficient demand, which means there is no problem of demand. Demand is not the one that is stoking the flames of inflation. These flames of inflation are stoked, amongst others, by what they call supply bottlenecks, but also to agree with Mr. Jammine, also caused by the fact that you have the problems of being on part of the global monetary system. And as being part of the global monetary system, unfortunately, and this is another angle which Mr. Jammine really brought, which is very important, I think we must elaborate as Saftu, because here we've got a view. There are speculators. So before, currency depreciation and appreciation would depend on the number of goods you export and the number of goods you export, goods and services you export and import. So that would more exports will tighten and lead to the appreciation of your currency, and more importation will lead to the devaluation to a certain extent. But over time, after especially the Nixonian moment in the 1970s, what has happened is that they have entered into the market, the so-called currency traders, the speculators who come in and are actually profiting on the currency pair differentials. If South African rand is paired with the base currency of the world, which is the US dollar, they know, for instance, that if say, for instance, Jerome Powell raises the interest rates in America, and we do not raise interest rates here, these currency speculators will dump the South African rand and go for the dollar, which leads to further devaluation. And because we are a net importer, it will mean that those goods which are imported into the country come very expensive and also have some inflationary effect to that. So these are many other issues which I think as the South African Federation of Trade Unions, we have a problem.
Unfortunately, I always try. With Trevor, I know I need a little bit more time to explain these concepts. But Dr. Azar, Jammine, because of time, and unfortunately, we're going to have to leave it there. But I appreciate you all, and thank you very much for coming and trying to help us with these questions. Of course, we'll need to revisit this again to understand exactly what needs to happen here to bring down this inflation. In Focus continues next. Stay with us.